Welcome back to Investment 360. With us we have Ann Leepile, Head Manager Research Investment Solutions. And good having you on the show. Recently we were speaking to Glenn Silverman, who had just come back from a tour of fund managers around the world trying to ascertain their level of confidence with the global environment. And I'm going to throw forward to, I know you were on the same trip, but how do you feel coming back? Are you more confident or less confident about the sustainability of the global economy?
You know, I think previously these trips were always quite interesting because we'd come back with so many divergent views from the managers. And this time it really was just all around nervousness. It really is. I think the active managers, who we obviously spend most of our time with, are really struggling to make the returns, are struggling to beat the benchmarks, are struggling to beat the index. And it really is just moved to more of a risk-off type play, you know. So focusing on very comfortable counters, very strong cash flow counters, strong dividend plays, you know, your global routing but emerging market exposure type counters, you know, China on, China off. It's just, but everybody is just very nervous at the moment.
Wayne, this sounds like a very familiar story.
It sounds like investments to me, yeah, I must be honest. The one thing I do know is when every single person is betting one way, probably the good thing to bet the other way. It's probably a good thing, but I mean, understand this whole story. What Ann was talking about is, let's call it defensive shares versus cyclical shares. The valuations, now I'm only talking our share market now, the valuation between defensive shares, let's say SA Breweries, and cyclical shares, let's say Anglo-American or Billiton, is as high as what it ever has been. So these defensive shares, this risk-off type of scenario, has been pushed to extremes at the moment.
Yeah.
Now, if of course the whole world falls in a heap, then it's right to own defensive. But if the whole world doesn't fall in a heap, you know, you might actually be at some sort of changing cycle in the market. But so we have to monitor it very, very carefully, actually.
And what emanated as the top risk among the fund managers that you spoke to? Is it the breakup of the Eurozone? Is it potentially a hard landing in China? Is it too difficult to ascertain?
I think obviously current concern at the moment, or the most immediate concern, is the Eurozone. You know, we were actually there when the Prime Minister announced that there would be a Greek referendum and then subsequently changed his mind, etc.
And then was fired.
You know, and then was fired, exactly.
Okay.
So, you know, I think, but the longer term risk in terms of global bets is China going to have a hard landing, or is China actually going to be this big success story that everybody seems to have bought into? And we're seeing it with our local managers as well, as there's these China on, China off, you know.
So there's no level of agreement?
No, there's no level of agreement, but everybody has great justifications for the decisions they are making. So is China going to work? I promise you I could give you 10 reasons why it will. Is China going to fail? I can give you 10 reasons why it will. So, you know, it really is, it's a bit of a scary world at the moment.
But I mean, that's very typical of the asset management world. We're never wrong. We're just mistaken. And sometimes we were right, but it just took 3 years for our view to come right. So asset managers are never actually wrong in the view they give. They just, as I said, might be mistaken or might get their timing wrong.
Well, let's come back to local equities versus global equities and how people are feeling. Of course, we've heard the sentiment that most people are looking for value in the developed world rather than in the local market. Is that pretty much what you're hearing?
It is, but they are making sure that the counters they are buying have got great emerging market exposure. So they're sitting with, you know, companies that have got over 30% sitting in emerging market countries in terms of revenue generation, but these will be developed world counters. You know, as I said, the Nestle's, the Diageo's, your tobacco counters, those types of stocks are what we're seeing. You know, in 80% of the managers we spoke to, we were having the same names mentioned. This is completely unprecedented, because what we tend to do is see managers who play in different spaces, who play different themes, and everybody was talking the same story now.
So tobacco and beer.
Probably time to short it. If every single person and their dog has got these shares, I mean, understand BAT, which is the tobacco company, this is up 40% this year in rand terms, well, on our market. I mean, this is big for a defensive share. You've had huge price appreciation from it. Now, obviously we're going, I mean, the world's gone through trouble before. The trouble has always sorted itself out somehow. If this trouble
is big trouble, Wayne. I mean,
this
is very big trouble.
I mean, we've gone through world wars and we've gone through big trouble before as well. And somehow we've all survived. And if we survive, then you must buy the cyclicals and sell the defensive. So it's very much dependent on what your view is of what's going to happen. To me, China is way more important than Europe. For our share market, it's way more important. On the valuation of South African shares versus global shares, developed market shares looked quite cheap in local currency terms.
Yeah.
I'm just not sure anymore with the rand where it is. I think the rand's got a chance of strengthening from this level. So a couple of months ago, it was clear-cut, you must take money overseas. I don't think it's as clear-cut anymore.
The other theme that's been unfolding specifically on Business Tonight is that the US, and looking at the data points, is that there's certainly a more healthy environment out of the US. So let's put aside the special committee or the super committee that failed to reach agreement on the US's debt problems yesterday. But the data points, the economic data pointing to a healthier consumer, is that something that you picked up or not?
You know, I think it's very much a relative game. I think if one looks at the US relative to what's happening in the Eurozone, yes, it looks healthy. It looks like it's coming out of its problems. But if, you know, the US still has a lot of problems, the US still has a long time to get out of those problems. But if you have to put your money somewhere, it's got to be a Euro versus US story. And then, yes, the US does look a bit better.